Happy Friday, everybody. Welcome to the Deep Q Cast. Our handsome and courageous host, Rob Bridzak, is MIA today. He had some pressing issues that he needed to take care of. So today you are with Carlos and Matt, and we are going to do a quick rundown of the week in review for crypto. And I actually think this is a pretty special episode for us. We are gonna lift open the hood a bit on how to get a job in quant finance and what people are looking for. I think one of the things that we get contacted with quite regularly on LinkedIn and on Twitter is really from perspective, graduate students and college students who are wondering, like, how do you break into the world of finance? I think both Matt and I have been actively involved in recruiting across a number of different grad programs over the course of our decade-long career in Wall Street. And I think we've got a pretty acute view of what it takes to get a job, what it takes to succeed in your first couple of years, and probably most importantly, what it takes to get your first pay bump when you get to that point in your career. So it's kind of an interesting and really fun topic for us to discuss today. But because it is Friday at 4:00 in the afternoon,
it is.
What are you drinking today, Matt?
I'm on the stout. It's not Guinness. It's an Ebb stout. It's pretty good. Not as creamy as Guinness, but enjoying it. A bit sweeter.
It'll do. Yeah.
What about yourself?
I think this is the perfect weather for a really nice stout or a toasted porter. Right now, I've decided to go a little bit degen, and I'm drinking some scotch.
Hitting it early. I like it. Okay.
And every once in a while, you gotta get after it. And I feel like after the week that we've had in crypto, a little scotch is certainly well deserved.
Yeah, it's been like a tantalizing week, I would say, with kind of Bitcoin's been crossing the 1700k or hitting that resistance level, which it hasn't seen for some time now. Post FTX world,
it's flirting with that level, and every time it does, it's not so fast.
We're not ready. Yeah. Liquidity has definitely been improving this week. So one Bitcoin in this metric we've been discussing, like one Bitcoin in 10 seconds, is pretty much back on the cards now. And it seems like towards the end of this week, there's definitely been some risk on. There've been a few big macro points to note. So we've had the minutes, Fed minutes. We've had CPI for Europe, and we've had non-farm today. So today's pretty much where we've had some risk on moves into the close. But then starting as we should, starting at the start of the week. Genesis versus Gemini, I'm calling it, where Cameron Winklevoss sends that open letter to Barry Silbert, demanding action by the 8th of Jan. What do you make of that? I think the connotation is that they're going to try and force them into Chapter 11 bankruptcy after this weekend if they don't do anything.
I mean, I'm of mixed views about this. I actually don't think the Winklevii do this unless they think their hands are tied. Like, I think appealing to the court of public opinion is 100% like the appeal of last resort if you feel like you just have no other alternatives. So I'm actually going to take, believe it or not, I'm going to take the Winklevosses at face value and assume that they're actually trying to be upstanding people. And the only reason I say that is because, we've actually had personal dealings with the guys over at Genesis or at Gemini. And the one thing that I can say about that whole team from top to bottom is that they really, really, really care about doing things the right way. And if you look at, what they've done in terms of investing in the regulatory overhead required to be registered with New York State, which I think they're the only people that have done that. And I actually think from a legal perspective, outside of the Gemini Earn platform, Gemini itself is probably the safest U.S. Exchange. So I somewhat feel for them in the sense that they tried to do things the right way, but they got caught up in this, Earn platform, which, I mean, let's call a spade a spade. I don't think it was the right move, in hindsight anyway, to be able to sort of farm that out when you longed onto Genesis or Gemini. I think that they did everything correctly in the sense that like everything was well disclosed. But I mean, like as a for instance, you and I looked at that, and as FTX was going down, we said to ourselves, "Oh shit, we don't want Genesis counterparty exposure," and so therefore Gemini Earn is not a viable alternative for us right now.
Yep.
But I'm not sure that the average investor or the average sort of like retail investor looking at that was able to say like, oh, there's a distinction between Gemini the exchange and Gemini Earn, which exposed me to counterparty risk to Genesis. And without knowing sort of like the industry secrets or the industry insider, like what is Genesis's counterparty risk profile, how do they do their risk management? I mean, it gets a little murky.
Yeah, I mean, I kind of want to come back to that as well about Genesis in general. I think Thursday there was some news about them. They laid off 30% of their workforce. Digital Currency Group shut down one of their subsidiaries, which is like a asset management arm, HQ Digital. And then, but before we kind of talk about that, like, are they done? Because that could be a real scenario. I wanted to talk about, so on Thursday as well, there was a announcement, a judge regarding Celsius Earn. I do think this is one factor to think about if you were a Gemini Earn customer, is the Celsius, a judge ruled that the people that put tokens into Celsius Earn didn't actually own their tokens. And they're at the point of that transfer. So at that point, they then become part of the bankruptcy estate. And this is like, more of a contract law thing rather than it setting a precedent for like, you put coins on an exchange or anything. So I want to make that distinction. It's a very different thing. But I just think, people should check their agreements just so they don't have any surprises there. I
mean, 1,000%. I think, if you look at what we did as a firm, when FTX came down, which is we pulled all of our cash, and then we actually spent some time going through the nitty gritty, read documents, read legal stuff, called up, our representation at each of these places, and asked explicit questions like, all right, if you go down, where do we sit in your creditor stack?
Yeah.
And it is shocking the number of crypto firms out there where it's like, if we go bankrupt, you get piled on to the general creditor list, which means that, anyone that, is owed money by that crypto trading venue, you kind of get piled on with them. And in some ways, I think that this is like an upholding of the specifics of crypto, of contract law. But I also think this is a really bad precedent for, all of these crypto businesses where it's basically like, as a depositor of money, even though it's fine print on the document that says, hey, you become a general creditor of Celsius or Gemini Earn or whatever else program, I think that people were maybe not explicitly, but implicitly under the belief that this was more protected.
Yeah, and they'll just get them back.
So I think that this kind of falls under the category. And we used to talk about this in banking all the time, what we call like reputational risk, right? It's like, did you explicitly do anything wrong? No. But does this absolutely murder your reputation in the market? Yes. And I think that's the problem that these places are going to have to deal with, is sort of like, did Gemini, the exchange, do anything wrong? No. And if you are just a general exchange user on Gemini, are you under any risk right now? Absolutely not. Look at their regulatory burden. It's actually like, you're pretty solid there. We feel very comfortable parking a lot of our crypto and cash at Gemini right now. And this isn't an advertisement for Gemini. I'm just saying under the law, they're registered as a New York, exchange. And so, under a bankruptcy scenario, a depositor under the exchange is actually pretty well protected. If you sign away those rights and sign up for this earn program, let the buyer beware. And I think that's the problem when it comes to these sorts of things, is that I think that they will have a problem, whereas they explicitly told people in the fine print, and so they're legally covered. But all of the other, like the tone around the advertising and the splash page on the website and everything else indicated it's like, oh yeah, this is a perfectly safe thing. I put my money into GUSD. It's FDIC insured. I loan it out to Genesis. It's like a guaranteed 7% return. Everything's cool. It's above board. You're like a registered, regulated entity. Everything's great. And then you read the fine print and it says, by the way, you're a counterparty to Genesis and not Gemini. You could lose all of your money.
Yeah.
And
that's the key.
Good luck.
Yeah. Yeah, I mean, there's definitely been some repercussions for other exchanges this week. We know Gemini are getting sued for that, full stop anyway. Yeah. There's a class action lawsuit against them. I think Coinbase also got fined Wednesday, so fined 100 million. They've been charged 50 by the New York Department of Financial Services. And then the other 50 they have to use to beef up their own KYC and AML policies. And that was due to some stuff that happened, I think, a year or so ago, where they're doing some guy inside had some inside accounts that weren't disclosed.
Yeah.
Doing some weird funding.
But I think to be fair, I shit on the SEC all the time. I do. I just don't trust Gary Gensler as far as I can throw him. But I will say one thing. It is well documented at this point that Coinbase asked the SEC if they should do a yield program, and the SEC said no. They did not do it.
Yeah, that's true.
To be honest, they're probably the only exchange out there, like them and Kraken right now are the only exchanges out there that haven't got nabbed up in any of this counterparty risk where, they offered some sort of like yield program that ended up blowing up in their face. So, I mean, as much as I speak ill of the regulator because I think their incentives are not aligned, in this one case, I will actually give credit where credit's due and say that they did a fine job at protecting consumers by telling Coinbase that they should not offer a yield program.
Yeah. I think we can keep that. I was going to talk about some of the macro stuff, but I want to actually just keep them to the end. If I'll go out of order in chronology, and instead let's talk about Silvergate. So, just because you said about the lending, mad lending pandemic that we've just had, contagion effect, it's actually now hitting Silvergate, which is, actually, how old is Silvergate? Do you remember? I think they're like what? They're pretty old. So
they're not a new bank. They've been around for a while. I think that the newishness of it is they've pivoted into crypto.
Yeah, I think you're right. I mean, they're definitely one of there's Silvergate, Signature, a couple of others, Monty something. I forget the name now. But yeah, there's a few big-ish banks that will seem more willing to do crypto because we talked about this before. None of the TradFi banks would touch us a while ago.
I mean, because this is actually a good story. When Matt and I founded DeepQ Digital, we quit our jobs, and when you quit a banking job, you have what's called a garden leave, where you're still employed by the bank, but you're kind of just sitting on the sidelines. You're not allowed to have access to your email or Bloomberg or anything like that. It's meant to be a period where you're information regarding the market can sort of like decay. And I remember like the week after our garden leave was over, Matt and I got in a car. We went over to JP Morgan. Both Matt and I do some personal banking there. And so we were like, we've got significant assets at JP Morgan. Like we're customers there. We'll just roll in, start a business account, and they'll be super happy to have our business. And the guy looked at us like, "Are you fucking crazy?" No.
He's like, "Crypto? No, that's got a number. That's not what's the business. Crypto? No.
No, we don't do that. We just don't." And he's like, "You can." And to his credit, he was like, listen, you can maybe go to a smaller bank and you can tell them that you're like a technology company, not a crypto company. But the minute you say crypto, most banks won't touch you. And that then began probably a 2-month period where the number one issue that we were facing as a firm was, can we actually find a bank that will take our money? And we're not even talking like we were trying to loan money, or like we were like trying to loan money based off of our crypto deposits. We're literally
just
talking about a business checking account to pay bills. And what we found is that as a U.S. corporation, you really have two options to get a bank account as a crypto firm, and that is Silvergate, and then the second one is reasonably newish, but gaining a lot of momentum, which is Signature. And we opted to go for Signature for two reasons. The first is they do a lot of business outside of crypto. So we felt like from a balance sheet perspective, we were to, park money at Signature. And if crypto were to blow up, they're diversified enough that, we'd be safe. But also they were probably one of the only banks that didn't charge an exorbitant fee just to exist.
Yeah.
I think Silvergate, when we talked to them, was like, cool, we will charge you $500 a month for a checking account, and you need to park $100K minimum at the bank to keep an account live. And it's not that big of a deal, but at the same time, when you're a startup, you're like, why am I going to spend $500 a month for a business checking account, which is free for any other type of business? It's really insane. And we had a couple other people that were not Signature and not Silvergate that were like, yeah, if you park $5 million here and pay us $2,000 a month, we'll let you have a business checking account. It was absolutely insane. I was absolutely floored by the hazard pay that they extracted out of us to try and just have like a simple checking account. So I guess if Silvergate were to go down, one, that would be a massive blow to the industry, because I think that would shut off a vast majority of the what I'd call crypto to fiat on-ramp in the US. And then second, what it does is the Silvergate exchange network is a huge portion of liquidity in the market. I don't know, Matt, do you want to go into what the implications of the Silvergate exchange network going down would be in terms of liquidity?
Silvergate have their own effectively blockchain, as Carl said, the Silvergate exchange network, SEN, and it allows participants to send cash pretty quickly, almost immediately. I mean, it's just effectively Venmo, but it's for bank to bank transfers, or it can be an exchange, can be part of it. So and the deposits will happen in 10 seconds or something. So a lot of companies that are trying to fund efficiently on exchange will use that, and then they'll move it back at the end of the day, for instance. So again, you don't leave cash on and have counterparty risk. So I think, but it's actually interesting. So the report they released on Thursday, their Q4, and I don't know if it was their announcement or they just released a note, but it was like their deposits from digital asset customers went down from effectively 12 billion to 4. So they basically lost 60% of their deposits.
That's notable. But
I mean, it really was. So they basically had enough wholesale funding to satisfy the outflows, but then they were not left with enough of a buffer. So they then had to sell a bunch of, and they say this clearly in their their document that they had to sell a bunch of debt securities and related derivatives for cash, which meant they then had a 718 million loss on those. And that's kind of the thing. So they're posting a pretty chunky loss, and their share price has also taken a tumble. So I think like Kathy Woods from the ARK fund, they're basically holding now 1%. They reduced almost their entire holding of it, and the stock price has been annihilated the last couple of days. I think like 40-50% or something.
So, but to be clear, from a liquidity perspective, if you think, like, what does this actually mean? I think the main issue that you come across right now is, like, what's the purpose of the SEN? Right? The SEN allows market makers to, let's say you find an arbitrage between Coinbase and Kraken, right? Prior to Silvergate, in order to close out that arbitrage, you had to trade the Bitcoin on both exchanges, and then you had to wire the money back and forth between your bank account and Kraken, and then your bank account and Coinbase. And that process in and of itself could take, hours to days, and also be very laden with fees. So Silvergate basically came in and said, all right, we actually bank you, the fund, we bank Coinbase, and we also bank Kraken. So we know what you all have in accounts. What we'll do is we'll just treat that as an internal debit or credit, and we'll move that money instantaneously. And so now as a crypto firm who's trying to, arbitrage, Kraken and Gemini, that price discovery mechanism to make sure that the price is equal across both of them is now an instantaneous thing. And the cost and the time that it takes to move that means that without a whole lot of capital, you can actually do that arbitrage and you can close it. So if you remove Silvergate, which probably banks, I'm going to go out on a limb and say, 75% of the US-based crypto funds, you remove actually a good portion of the market's ability to efficiently transfer capital across exchanges and close out arbitrages. So my guess is that the more fear there is on Silvergate, the more you're going to see dislocations in prices across different venues, because market makers are going to be like, oh shit, I could make, 0.5% closing out this arbitrage, but if I do, and then Silvergate goes down in the process, I lose 100% of my money. That risk asymmetry doesn't make sense to me, so I'm just going to sit on the sidelines. And so now you have these massive arbitrages and price dislocations across venues that are allowed to exist for, a good long period of time. I think you're going to see a significant decrease in the amount of liquidity in the market simply because they serve such a vital portion of the infrastructure of the market. And it's going to make it really, really, really difficult for people to be able to move money efficiently across venues and exchanges.
Yeah, I mean, they're not out of the game yet, just to caveat.
Oh, yeah, no, I'm not trying to spread fear on this. I'm just saying, if it does happen, this is actually a pretty monumental story.
Yeah, for sure. It'll be like it's the true contagion of that whole debt services in crypto spreading now to a traditional banking run, effectively. It's like a new form of bank
highlight
run,
sort of like
we've never had a crypto.
The gap in that crypto fiat on-ramp that basically two banks, Signature and Silvergate, own the entire market. And if those two banks go under, then...
No, that's the story.
How does money flow into the crypto ecosystem right now?
Yeah. I mean, it just calls for more interesting use cases in DeFi as well, I think, just so there's not that reliance. But
for sure. But I mean, even if you're doing DeFi... in order to move cash in size into crypto, you still need to move actual physical cash into.
You need an on-ramp, yes. True.
Yeah. So.
Yeah. I mean, yeah, it's been a pretty big week. I think the other thing we touched on already was like Genesis. What are your thoughts there, Carlos? We said, like, that there's the 8th of Jan deadline. You're not convinced about that. But then they have definitely laid off more staff this week. And like I said, that DCG group have closed down a couple of other businesses.
I mean, I'll just go on a limb here. I don't think that anyone is under any illusion that Genesis is going to survive this. I think the market's pretty much priced in that it's going to go under. It's really a matter of when and under what
Just
circumstances. And I think that
someone say it's happening today, every other day.
Yeah, no, exactly. I mean, like, you think about it, like, if you're in the industry, people are going to call you or text you, be like, "Oh man, Genesis, watch out!" And I'm like, "Yeah, but like we've been waiting for this for fucking like 3 months now at this point. Just like get it over with." And in all honesty, I think the market would be better off if they just had an orderly liquidation now rather than prolong it. But I don't think that's going to end up happening. I mean, Barry Silbert, by training, was a bankruptcy specialist in investment banking before he moved into crypto. So, I mean, he's sort of like in his element right now. And I kind of like, there's this great story I think it's like the Buddhist tradition where, a man is walking down the road and a snake says to him, "Hey, I'm a snake. You should pet me." And the guy says, "No, but you're a snake. You're going to bite me." He's like, No. I'm totally safe. You should just pet me." And so the guy reaches out his hand to pet the snake, and the snake bites him. He's like, "Ow, you bit me." He's like, "Yeah, I'm a snake. What did you expect?" So, I mean, you're dealing with...
It actually reminds me of the Fed. We're going to hike.
I mean, this is also true. Yeah, perfect segue into our next point of conversation. Point being, Barry Silbert is a snake. I mean, and not in like a bad way. Just like he's an operator. He knows how to work. He knows how to work within the constructs of contract law. He's not a dumb guy. Typically, billionaires come with a very savvy legal team and a whole lot of really smart people around them. I don't think this is going to go down clean because the stakes are too high. So if Gemini thinks they're going to send a tweet out and Barry Silbert's going to be like, "Oh yeah, by the way, cool, we're just going to liquidate all of our interests and here's your money," like, good fucking luck with that. I think it's going to be a bit more of a drawn out procedure than we expect. I think probably to the detriment of the market. But that being said, my view has been, and I will reiterate this for the next month, the market's pretty much priced in all the catastrophic shit that can happen, with the exception of probably Bitcoin and or Tether going down. So I don't think this is going to have a massive downside on the market, but I don't think we're going to see upside until this gets resolved.
Yep. Agreed. And so then I guess we can... I don't know, what else happened in the crypto sector? Anything else? I'm trying to think.
No, I mean, honestly, I think...
It's been a busy week, but yeah.
Yeah, I mean, busy week. Everyone got back to work this year and was like, let's get this shit underway. I think that's probably the big thing. Let's switch gears over to macro itself, because there's a lot of really important things that happened in the macro market this week.
Yeah, I mean, so it kind of kicked off on Wednesday. So we got the FOMC minutes at the usual 2 p.m. It basically, the gist is they seem a bit concerned that they're going to have to keep raising rates more than projected, like if the bond prices and stocks continue to rally. And given they had some US job openings that fell less than expected in November, that kind of keeps the pressure on for the Fed to keep this runway to hike. Obviously, we'll talk about the NFP in a minute, but that was kind of what came out. And then the other thing we had was like one of the Fed Minneapolis guys was like, "No, we should be hiking 100 basis points through next year. It's like 5.5%. He's like super hawkish. And I think that just really was telling in the price of stocks. They trimmed gains immediately after this came out, and like Bitcoin as well sold off from the highs. We were very close to like the 17,000, sorry, and just broke down through to like sold off about $150 straight after that came out. So it's kind of.
But I think that's like, honestly, I think if you're a discretionary macro trader who deals in anything crypto, the trade for probably the next couple months is marking your calendar in red anytime Jay Powell speaks.
Just see what the sentiment is.
And short it. Because I fully don't understand it, because we talked about this in the last episode. The Fed has telegraphed exactly what it plans to do, and it's sticking to it. For better, for you can agree with him or you can't, but they've told you exactly what they're going to do, and they've been doing it. And if you believe for any amount of time that the Fed's going to walk in and be like, oh, by the way, we're just super dovish and we're going to print some money and crypto is going to go up and we really care about the stock market and we really care about your crypto gains. No, they don't. Jay Powell only cares about the metrics that he cares about, and he does not give a fuck about stocks, and he extra does not give a fuck about crypto. So if you expect anything other than him being super hawkish anytime he opens his mouth for the next 6 months, then I think you're absolutely fooling yourself.
Well, I mean, it's funny you say that. That's kind of like the so we got NFP today. So payrolls were up. So that's a signal that you should potentially continue your hiking progress. You haven't made any significant impact to the jobs market, but a lot of the jobs that were added were coming from leisure and hospitality. I think those were two of the main sectors. So they're kind of still not even back to pre-COVID levels. So an economy that's still recovering from that, you'd expect larger gains there. And then the other piece was there is a notable decline in wage growth. And so that's the thing now why I think people are jumping on, that they'll be slightly less aggressive, maybe going for the 25, definitely instead of the 50, which there was a big jump in the 25 basis point hike for Fed. Yeah. But yeah, I mean, we're going to get the CPI, I think, next week on Thursday. So, No,
I think what you're going to see is the CPI is going to continue to go down. And the Fed has explicitly said that it's watching the labor market. So the labor market is now going, NFP is now going to move markets more than anything else. CPI is kind of priced in and it's going to go down. But the problem with the labor market is the labor market lags the economy. So it takes some time for that to flow through. And the real question is, do you believe the Fed that, that they're watching the labor market and that they have the ability to synthesize that information in a meaningful way and to accurately say, oh, well, we understand that the labor market is still a little hot, but let's look at the nuance of that market and, let's try and understand whether or not, this leads to, a downturn future down the road. And I think the initial reaction to NFP today was that the numbers beat the prediction, and just in terms of overall job growth. And then after the fact, people thought to themselves, oh, actually, but there's some subtleties around this. And so they revised their, predictions. And so things tended to rally back a little bit. But it's going to be a bit of a game where people are looking, at those nuances, and they're going to play this game of greater fools that basically says how is the Fed going to respond to this data? And to be honest, it's kind of like a sick and perverse thing where if you're bullish stocks and crypto right now, you're secretly hoping for the middle class to go routed and laid off and have an economic downturn so that your stocks and crypto can go up. So it's It's my
Thanks for that happy
2 cents
thought,
on the matter.
Carlos.
Yeah.
Yeah, I guess to finalise then, the Europe CPI also came out today. It was their inflation for core CPI is record high. It's 5.2%. If you strip out energy and food, that's the difference, and that's continuing up. The total CPI print came down, so overall prices are down from double digits, but definitely no signal for the ECB to stop their hiking, which we've talked about could potentially further exasperate the debt crisis that's looming in Europe. But
yeah, no, I think no matter what you think about the U.S. economic circumstances, you look at Japan and you look at Europe, and they are double fucked compared to the U.S. And whatever we're going through in the U.S. 6 months ago is what Europe is going through right now, and I don't think it's going to be an easy road for them.
Yep.
Happy New Year.
People will be like, wow, I'm coming to these podcasts, I've got a guy from Birmingham talking, and then I've got Carlos saying, the world's going to end.
I don't know. I don't think the world's going to end. I'm actually pretty optimistic about the future. Wait, I just think that there's a little bit of pain that we're going to have to
give something good, then the shit, then something good at the end after. So let's talk about the jobs thing then. So let's go on to that.
Let's talk about jobs. Let's talk about how you get paid.
Yes, there we go.
No, I mean, so this is an interesting one. I have spent the better part of my career mentoring junior quants and traders on how to get paid within the construct of a banking environment, and then not only how to get paid, but how to get a job. So I think it's interesting to talk about. I guess let's break this up into 3 segments, which is what skills are needed to get your foot in the door. Secondary is once you've got your foot in the door, meaning once you've gotten past the initial screening, like your resume gets picked up, how do you sell yourself, right? And then probably the next bit is, once you actually land on a desk, how do you go from being, a junior guy on the desk to someone who is actually a contributing member of the team and kind of earn your first proper payday? So, first things first, if you were to say,
as someone who quant job, because a lot of times people say, I've asked, what does that mean? What is it? And I think it really depends. Like a lot of, for instance, on the sell side, you could be a quant analyst, say. And
what does the sell side mean, actually? Why don't you define sell side?
So sell side it's banking institutions that we're all familiar with, your HSBCs, your Goldmans, your Barclays, all the big guys. And sell side is there where there was a rule where banks had to separate their proprietary trading and their customer flow and customer funds effectively. So you can't bet with your deposits in the bank. So because of that, there's an awful lot of guys that kind of move then onto the buy side, and buy side is where you take bets basically on the market. You formulate a view and you'll put on a strategy or a decision. So there's plenty of buy side funds out there, Winton Capital, Citadel, to name like 2. So what's the biggest one actually, Carlos? I forget. We chatted about it the other day. Just lost stuff.
You've got like Bridgewater, AQR, 2 Sigma,
right?
Man AHL.
There's if you really look at quant
Citadel
hedge funds, or I guess there's like quant hedge funds is really the name, and that would be more on the buy side. And what does that mean? Well, it means you're usually using one of the sell side banks to buy stuff, or potentially you're also acting on one of those public central limit order books we talked about the other week. If you've got the funds, then you can trade through there as well. So that's the kind of distinction. Sell side's more service orientated, and you're generally not placing orders in order to put risk on, unless it's in anticipation of client flow. Whereas on a buy side, you can do whatever you want. I think that's fair, within reason.
So this is actually, I think it's an interesting distinction, because prior to Dodd-Frank and MiFID and like the series of banking regulations that basically said banks are not allowed to trade their own capital. The only thing they're allowed to do is take a client flow and hedge it in the market and then earn some spread.
And hedge can be anything. Just as long as you can show it's a correlated asset class to the thing you're trading.
Yeah.
Because hedging stuff one-to-one is actually very expensive, to make that clear as well. So as long as you can show that there is a correlation, you can hedge across a spectrum of things.
Let's break it into three categories, right? The strict definition of sell side is a client comes in and buys from me, and I go to the market immediately, and I try and hedge that and offset that risk immediately. And the only way that I make money on that is that the client's willing to pay me a slightly higher price than the rate at which I can go out and hedge in the market. And so I earn some tiny spread on that. Think of it more like a commission, right? And then on the other end of the spectrum, it would be I only take orders, or I only trade when I have a view. So if I feel the market's going to go up, I'm only buying, and I'm only dealing with people that want to sell to me.
Yeah.
Now, there is some gray area which you can live in as a market maker or a bank, which is I will take on risk when it suits me or when I have a view, and I will hedge it. Or in some ways, what you can say is like, I think a lot of clients are going to buy from me, so therefore, in anticipation of that flow, I'm going to get long the market.
Yeah, and that goes back to like, even if you own a store and someone says, hey, I want to buy 500 Mars bars, then you as the store owner is going to go, I've got to get some Mars bar. You're not like doing anything bad. You're just sourcing inventory.
Yeah. And so that in some ways is a gray area, because at its like purest form, you're saying, oh, my customers want Mars bars. And then there's also this aspect of like, wink, wink, my customers want Mars bars. So I'm going to go buy some. Sure. and a regulator is going to come in and they're like, well, why did you buy 500 Mars bars? You're like, well, wink, wink, my customers wanted those Mars bars. And it could be a bet. It could not be a bet. But as long as there's some justifiable way that you can tell people, well, my customers wanted it, then you can classify that as being a hedge, and therefore you fall under all of the rules that apply to banks. So let's say that banks fall under the category of purely market making, in the sense of, on average, my customers buy 10 Mars bars a week, so I'm going to buy 10 Mars bars in anticipation of that, and I send it out. And there's some gray area where it's like, well, wink, wink, I think my customers maybe want 100 Mars bars this week, so I'm going to buy them just because the price of Mars bars in the market is pretty attractive to me, so I think that's good. And that's sort of a gray area. And then on the other end of the spectrum,
but there are risk limits, so that kind of bounds how much you can do it. So you can't buy 5 million Mars bars because you'll just get shut down. There's clearly
exactly, versus at a hedge fund, you can be like, listen, I think Mars bars are cheap, and I want to buy 5 million Mars bars right now. Go fuck yourself. I don't care who wants to buy them from me.
If you own that shop and you don't have this regulator over you, you can buy. I'm buying all the Mars bars today.
And it used to be that gray line just didn't. No one gave a fuck about it, right? Like at a bank prior to 2013, you would have market makers and proprietary traders sitting right next to each other. They would collaborate, and the bank would be like, "Yo, by the way, our smartest clients are buying Mars bars, so we should go out and buy 5 million Mars bars and drive the price up." And that was totally legal And then post the financial crisis, everyone was like, well, maybe we should stop doing that. And the problem that you had in terms of getting a job on the buy side is that the way that it used to work is that the buy side didn't have the capability to hire people directly out of undergrad because it's expensive. It takes a lot of time. It takes a lot of effort to do that. And so what they would do is they would let the banks hire people and teach them how to put on risk. And then those banks would then, then those hedge funds would go and they'd poach the best people at the banks and pull them into the buy side. And that doesn't exist anymore because the skill sets on opposite ends of the spectrums are way different. And so you've got people on banks, a lot of banks live in that very regulatory driven spectrum where they say, cool, we're just going to buy at this level and we're going to sell at this level and we're going to earn our little commission and we want to be a very steady fee-based business and that's what we do. Well, then you can't do that on the buy side because on the buy side, that's not their business model. Their model is putting on actual risk. So it used to be that the way to get onto a hedge fund was to go work at a bank and cut your teeth there. And then when you got done at the bank, after a couple of years, you'd go work at a hedge fund if you were good. And that just doesn't work anymore because the skill set to be a market maker doesn't transfer over to the buy side anymore. I mean, you tell me, do you think that's fair, Matt?
I never worked on the buy side explicitly, so I wouldn't be able to say, but friends that I know in that area don't think about risk in the same way, that's for sure.
Yeah.
Well, I mean, there's just so much less oversight. I mean, don't get me wrong, they still have risk appetites laid out and all this, but yeah, it's just a different set of constraints they're operating under.
Yeah. And then even in the buy side, or even on the sell side, you're going to have different functions within the bank. So like if you're a quant, let's say you have a PhD in physics or you get a master's in computational finance or something and you want to be a quant at a bank. There's a number of different functions you can be at the bank. So you can be, for example, like a front office quant. And that front office quant would be involved in generating alpha models, in generating pricing models, and actually putting on risk as a function of the models that you create. And then you could also be in a role where your job is to validate the models that the front office quant makes. So let's say, for example, the front office quant generates like a linear regression that predicts the price of euro dollar, whether it's going to go up or down. You might have another model review job at a bank that their job is to say, okay, we need to make sure that that regression is properly documented, that we've tested boundary conditions. We know if the market's going to go up or down, how that reacts, and what the implications to our risk as a business are. And then we need to document that and communicate it to the regulator at the CFTC or the SEC. And that's our job. Our job is to be the governance of the people that generate money. And even though it's the same rough skill set, it's a different pay grade and a different recruiting process altogether. And then you also have people that kind of exist in the middle of that say, okay, you might have this governance program, you might have this front office program, and then we're the guys that sit in the middle and we look at the risk from the overall business. So what we'll do is we'll look and we'll say, you know, the U.S. Treasuries guys have a model that does this and they're putting on risk, and the FX guys have a model that does this. And in their own silo, the foreign exchange guys are looking at Eurodollar risk, and the U.S. Treasuries guys are looking at U.S. yield curve risk. But we also know that they're correlated, and so we now need to put together this like global model that tells us that these guys can put on their own risk, but that you can also look at the correlation between those risks and say what's the best thing for the firm, and they can then call up the guys in the Treasury's desk and say, actually, we think you have too much risk on, or the guys on the FX desk that can say, we actually think you guys have too much risk on, and they can manage that risk across like a global firm level. So there's a number of different jobs that you can even exist on across all of those different functions. And to be honest, they all have different recruiting profiles, and they also have different pay scales as well.
And I think actually that's a good distinction, because you mentioned about all these different kind of quant roles that exist. But then even just dealing with like on the fixed business side, I just want to get back to this one point on the difference between sell side and buy side. So on a sell side fixed income set of desks, you'd have credit, FX, treasuries, or rates in general, right? And then they have the same one customer that will come and deal. It could be BlackRock or Vanguard. They'll deal with each of them, and you'll get ranked as a bank across that entire portfolio. So it could be that you have to give really terrible pricing for you in the treasuries desk, because they do so much flow on the credit desk, but they'll only deal with you as a bank if you do really well on all of the tiers. And that's kind of a difference with the buy side. Buy side, you'll have pods, which can be independent quant teams, all working on FX, all doing separate siloed strategies with very little over interaction as well.
Yeah, no, I think that's totally fair. So let's get into brass tacks then.
Yes.
How do you get a job? Like, if you're a recruiting manager, what do you look for?
Yeah, so I've been asked a few times, like, what kind of degrees and stuff do I need? So for our desk, it was typically like a master's, up to a master's would be kind of the minimum in a STEM research, so something statistics based, or one of the classic STEM comp sci if it was going to be working specifically on our algo tech. But otherwise, for like the modeling piece on the quant desk, it would be, you kind of want someone that's well rounded, that they need to know how computers work, because that's our business. But even then, it can be split. Some banks have separate teams that build the core infrastructure, and then some banks work purely on the quant models that go into them. I actually think it's good to have someone that can do both. And so in terms of like basic requirements, I think you definitely need to be good with, you will have had to do an undergrad or be able to show your competency. And the sad thing is, if you haven't done an undergrad, you likely wouldn't get into you wouldn't get a look in anyway. It's just the way the systems are.
I would go as far as to say that in a quant trading role at a bank, you minimum need a master's.
Yeah, I agree.
I don't know. I'd say in terms of like breakdowns and percentages, 10% have just a bachelor's degree. 30% have a master's, and then 60% have a PhD. And I usually tell undergrads that reach out to me, hey, what should I do to get a job on Wall Street as a quant? I usually say, look into a really good grad program.
Yeah, and I think that's partly just, I mean, would you take an undergrad? Like, I would, if I thought they were good and passed my like minimum like stats questions. And because there is definitely another level, but most master's programs, it's 1, maybe 2 years. Like,
well, this actually comes into the question of, would I take them personally? Yes. Is the system set up to handle them? No.
I think that's the point. Yeah, that's the point. That's what I was trying to say.
Maybe
you don't really get a look at anyone below a master's degree, just because those CVs never make it to your desk.
And let me outline maybe the process for getting like recruiting at a large bank. So let's say you apply to a job at Goldman or JP Morgan or whatever. They have an HR team, and that HR team will either screen CVs themselves or they'll outsource it to some algorithmic company to do it. There's been a trend to outsource it to an algorithmic company to remove bias from the equation, so that you don't have basically like a bunch of Harvard grads basically saying, oh, we only want Harvard grads because they look like us. And that's a reasonably new thing, but effectively what ends up happening is you get a team of people who are not connected to the business. Like, if for every role at Goldman Sachs you get 1,000 applicants, they're not going to give 1,000 CVs to the hiring manager. They're going to give 100 CVs to the hiring managers. The very first thing that happens is you have to go through some purely like quantitative process where they screen your CV for buzzwords and they look at what school you went to. And to be honest, what school you went to is probably the most important thing. And they say, okay, let's classify people with GPAs above this level that went to target schools. And the target schools isn't because they believe that people that went to Princeton and Harvard are better. It's purely because from a cost-effective perspective, it's easier to send recruiters to 5 schools that you know and have a relationship with than it is to send the guys on the desk to go to 30 schools to go recruit those people. Because you think, like, if I'm a director or an MD on a desk and I go on a recruiting trip, right? I'm generating as a director or MD anywhere between $10 to $30 million a year in revenue. So you take me off the desk for a day, that's actually a pretty large chunk of revenue that I'm missing. And for every day that I'm off, there's an opportunity cost for that. And I can only really afford to send those guys off to on-campus recruiting visits for a very small amount of period. So, and then you factor in, you know, the cost and the energy that it takes to maintain relationships with like counselors and admissions people and all the sorts of stuff from all these number of schools. Generally what it comes down to is you just get lazy and you're like, all right, fine. I've had luck recruiting from MIT and Cambridge and Oxford and Princeton and Harvard and, you know, Carnegie Mellon and NYU and Baruch College in Columbia. And that's where I'm just going to, you know, park there just because it's easy, not because the guys there are better than the guys at University of Michigan or, you know, University of Virginia or whatever state school or wherever you want to go to. It's simply just because they have relationships and they have people that they know funnel into the system there. So you start there, you get funneled down from like 1,000 applicants to 100. And then from there, you get brought in for like a super day where you're going to meet with, you know, vice presidents, directors, and managing directors on the desk. And so like the first thing is like, how do I get from the 1,000 people that apply to the 100 people that actually get screened to get like the first interview? And if you were to give advice like, all right, how do I go from the 1,000 people to the 100 people? What would you tell people that?
I mean, you've got to demonstrate that you are actively interested in this. And I think it depends. Like if you're going for a grad program, you can be a little bit more general. But if you went to a place with already a good kind of quant skill set, and you spoke to these people and said, I want to do like e-trading or quant trading, make sure you get on that desk when you're there. And they have programs available. Most banks do now.
Yeah.
You know, not just banks, right? Everywhere has a quant applications you can apply for. But you just have to show that you've done your homework. That's the key.
Mm-hmm. I would say the 2 biggest indicators between getting the first cut to me is have a very strong STEM background, show that you're interested, like invest in someone that can help you build a really good CV that gets past all the keyword filters. And I hate to say this, at least for large institutions, go to the right school. And if you didn't go to the right school, network your ass off. Like, reach out to people on LinkedIn, find people in your alumni network, and know as many people as you possibly can. Because there is, I would say in my experience, there is some degree of leeway. Like, for example, in my career as like a hiring manager, once I got a certain degree of political capital, you could go and be like, listen, this guy's pretty good. Bring him in for an interview, regardless of what school he went to. Yeah, but that was like a very special thing, and that required a lot of hustling on the networking side.
I guess I didn't go through that process, so I'm never the best one to advise on those kind of screenings. My I mean, I'll be honest, I didn't know what I wanted to do. Like, I did do a PhD, finished it, had no real clue what I wanted to do. I'd always lived with people that were doing finance at uni, so kind of got an interest in it. But it was never the first thing to, I'm going to go work for a bank. Basically, I finished the PhD, a guy, I put a profile out somewhere, a guy from a headhunter somehow found it and called me and said, hey, do you want this interview for this quant gig? And I was like, sure. And I think I had like 3 lined up. One of them was for some options gig at HSBC. No, Standard and Chartered, is it? I forget now. Yeah. Which went terribly. I knew nothing really about how to price those derivatives at the time, but they still sent me there. And then, which was what the job was, they just didn't really tell me much about it. And then I had this one at DB for a portfolio team. So I didn't start on the e-trading desk, which is where I ended up. But after a year and a half, I migrated to the trading desk. And that was really just through, once I got there, things happened where I met people, and that's how I ended up with this career that I generally loved. Like, e-trading is probably, for me, one of the most exciting areas you can look at, because it's time series, it's large data sets. Well, most of the time it's large data sets. It's applying a lot of stats. You get direct reward feedback, so you can try a strategy and then you'll deploy it and see. And you can see real impact almost immediately. So I don't know.
I think it's an interesting career path because you came from a PhD program and you started in more of like a risk function. And then because you're really good at what you do and you networked very well and people liked you.
Yeah, that was also strange. I kept getting lent out to desks to help with stuff. And I'm not sure if that's just the team eventually finished not long after I left, so that could be partly why I was lent to desk. But that was a really good place.
Can I give maybe a little bit of like third party view on this, because for context, Matt moved to New York, and you were what, like a VP or an associate?
Associate.
When you moved to New York? Yeah, so like in banking, you start off as an analyst, as if you come from an undergrad. If you come from a master's or a PhD program, they hire you as an associate. So Matt was like an associate, and they moved to New York. And I actually remember, because I was like a VP, I was just about to get promoted to director at the time, so I was like slightly more senior. And Matt was one of these guys where he showed up and he was just a really smart, really hungry, really talented associate. And because he was so good, everyone was like, oh shit, this guy's really good. Can we find a way to use him in the business? And so there's actually some value, if you think from a career perspective, of getting your foot in the door whichever way you want to, whichever way you can. And then once you show up, if you're good and you're personable and you know how to network and people are like, oh, actually, wow, like this guy's actually providing a lot of value. Then,
yeah, and I think that's the key. Like, from my journey anyway, like, I didn't know that's what I wanted to do. It kind of happened. The whole thing kind of happened, even moving to New York and everything. And then, like, clearly some opportunities came up, and hopefully that's, as you said, I've shown that I hungry and interested and had the cognitive capability. But then it's really just, as you said, get your foot in the door and then grind. I think that's one alternative way, which means you don't have to go this route where you're this kind of selective Ivy League way, which seems a bit restrictive in my view. Anyway,
it is. It really is. And to be fair, like that's the route I came in. Like I fell ass backwards because I went to an Ivy League grad program, and then they're like, "Oh yeah, you should just go to Wall Street." And so I ended up there. And then what I found is that there's actually kind of a mix where it's like you get in the front door, which is you go to an Ivy League feeder school, and then there's like the side door where you go to like a reputable grad program and you come in through some sort of like risk management or some other role, and then you show up with your foot in the door and you're just really good so that people can't ignore you. And then those guys almost always find their way to the top as well. And I think once you get to a certain level, you'll find that there's an equal mix of, target school guys and then also people that came through the side door who are just really talented and worked their way up. And there's really no differential other than the fact that, like, it's slightly easier to get your foot in the door from a target program than not. But once you get your foot in the door, you kind of like reset on a level playing field, and it's really more about how you contribute.
Yeah. Yeah, and also we were constantly trying to poach other quants from other areas of the bank, to be honest. So I'm just saying internal
it's
mobility is a real thing. A good company will have especially internal mobility, banks. Is what I'm saying.
Yeah, like I would, like, and I have people reach out to me all the time. It's like, oh, I've got this job here, and it's front office, and this job here, and it's middle office. I'm like, listen, guys, like, take the best job available to you at the time, but there's no, like, once you get your foot in the door, internal mobility is a massive thing, and there's a lot of opportunities for people that demonstrate themselves to be able to provide value. Full stop.
I was gonna say, I think
I guess like before we agree violently and start, like, getting into a hugging session, what does it mean to provide value? Because, like, that's the biggest thing from my perspective. Like, there are some people that are really good at interviewing and know all the the logic questions and the programming questions, and you get them on the desk and you're like, who the fuck are you? And then there are guys that really just know how to get shit done. So, like, what's the differential between getting your foot in the door and getting the job versus, like, once you're on the desk, you are providing value, and you then become the guy that's like, oh shit, I need that guy, and other people are asking about you and asking you, like, seeing if you want to get on their desk.
I think something that's worked well for me anyway is just always start humbly and make sure you ask questions. Always ask, because the most annoying thing is if someone doesn't ask, and then later on you're like, we talked about this last week, why are you asking about this now?
Yeah.
So always be really clear on the things you don't understand, because that will just come back to bite you every single time.
I would always tell grads, you have at least a year to ask stupid questions, and ask all of the stupid questions. Like, there's no punishment for asking a stupid question. Unless you get to the point where you've asked that stupid question like a half a dozen times and you still don't get it, then we'll start to question. But
maybe you have to get me a coffee if you ask it again or something.
Yeah, exactly. Yeah.
But I think that's the key, because you kind of learn by osmosis and going through the process, and just showing that you appreciate when you're given a task, and you do it as efficiently as you can. And, like, you can get some bits of it wrong, but then go through your thought process. And what I've always found is mentors will say, hey, this bit's wrong, well, let's reevaluate this. And that's the best way to learn. And I think, what little time people have, because, people are busy, they don't have time for you every second of the day. If you crack on, get to a point or get stuck, set up some time, discuss it, and then go away. Just make sure you get all the questions that you want asking, like, prepared. I think that just comes with, like, a research experience as well. You kind of get that, because that's really what it is. This job is like research, quant jobs. It's research, apply, or get your parameter set of the thing you're trying to solve, research it, apply it, discuss it, reevaluate it, and make sure it lines up with your hypothesis, and then you're going to test it. And, like, be prepared for it to fail, but then just be open-minded about that feedback loop and the feedback you get.
I think that's probably the biggest thing, because over the years, what I found is that the guys that are the most successful, or guys and girls that are the most successful in this business, are the ones that fall into the category of what I'd call a commercial quant. Because if you're not skilled, then you're just not very good, right? But I've also met people that are very skilled, but they're too meticulous, and so what ends up happening is they want to
the point of oblivion.
Exactly, and they want to chase every little detail, and they continue to do it, and they might be fantastic from a skill perspective. They might be fantastic at making these, like, great latex documents and have everything, like, really buttoned up, but it takes them 6 months to get to a conclusion that should have taken them 1 month. And in the end of the day, what you get paid for is making a rapid decision. And even if it's wrong, if you can make rapid decisions and learn from it over time, quickly, then you'll converge on the right answer much faster than someone that takes 6 months to make a decision very slowly. And then that person, has a very, like, if they're lucky, that 6 month decision leads to a really great P&L and they keep their job. Well, but if they're not, they're first on the chopping block.
I was going to say, I think ultimately that's what like a good kind of manager is as well. Like you have a bunch of things you need to solve, but you're really efficient at picking out, hearing what are the problems and then distilling, okay, what's the low hanging fruit that we can tackle that's going to give us the biggest reward for like bang for our buck. And that's kind of something you just kind of learn as you go.
No, 1,000%. I think.
And like we've had this discussion ourselves, like even with I remember making a note of this the other day, but with our like alpha modeling, where even if we ran something with 100% alpha accuracy, our P&L didn't jump by like 1,000% or something, or 100%. It doesn't scale in that way. So it's kind of like, okay, I could spend a hell of a lot more time figuring out how to make my alpha better, but what's the gain in my actual P&L that I'm going to get? Okay, maybe I should focus on something else as well. And you have to find out what those balances are. I think that's kind of what management help you do. And then if you start to pick that up as you're on the desk and like what's the right kind of strategies to help you distill that information.
Yeah, I think it makes total sense. So if you were to say, from a technical skill perspective, to get on a revenue generating seat at a bank or a hedge fund, what are the top skills that you would need, that you would look for in terms of like, this is the best bang for your buck to develop this skill, whether it's soft skill or a hard skill? Like, what's the skill that you think is like the thing?
Well, so I think I already said for soft, it would be like, being humble. But then like hard skills, I want good stats and, to be honest, good programming. Those are the two things that matter most to me.
What programming languages do you think are in 2023 the tops?
Several now in my time, which would be like anything from C++, Java, and Python. Most modeling we would do would be in Python, but then we'd always have to implement them in either one of those components. And I actually learned C++ first, then kind of learned Python after. I love Python. I think it's great, and all the libraries there are super like useful and powerful. And generally, like, C under the hood anyway, so they are pretty fast no matter what people say. But I think learning a low latency language, compiled language like C++ just gives you a better understanding of what's happening under the hood with a computer as well. Yeah.
So I'm going to break those languages up into implementation, like low-level languages, meaning in live trading, it needs to do a task and it needs to do it very fast.
Yeah.
And most firms choose between Java and C++. I'd say C++ is probably the bulk of that, although there are a fair number of places that use Java. And then there's also a category of jobs which is offline. I want to understand if I made the right decision in real time. And I need to use my historical data to do an analysis on that.
Or live streaming data. You might do something online as well.
Yeah. And I would say that the analysis task of understanding what the optimal thing to do is typically done in Python. And the other language of choice is KDB.
Yeah, I was going to say.
Which is sort of a proprietary time series database with a scripting language attached to it that is predominantly used in finance. And those are really the skills: C++ and Java, and then Python and KDB. And typically, you should learn Python in school, and then you'll learn KDB on the job because the licenses are pretty expensive, and most people don't learn that in school, and no one expects you to learn it. But just know that when you hit the desk, learning KDB will be important because most banks and hedge funds use KDB. And then I would actually amend the soft skill thing to say that humility is vastly important. And then I would probably also say the job that maybe not you need to get your first job, but the job you need to get promoted to VP and director, or the skill you need to get promoted to VP and director after that becomes presentation skills, both written and verbal.
Yeah.
And once you get to the point where you can explain very technical things to non-technical senior executives, that's when your first like really big pay bump happens, because suddenly executives say, this is a guy that I can put in front of clients. This is a guy I can put in front of investors. This is a guy that not only does the day-to-day stuff, but can also now drive business for me. And that's the difference in the quant world between getting paid $250,000 a year and $1 million a year.
Yeah, and to be honest, for me as a quant, that is the hardest skill to learn, or I've learned. And I think I'm still learning it even today, but how to be succinct with your language to get across the information required and no more. It's a pretty good skill to learn.
I mean, because ultimately what it comes down to is there is only so much programming you can do as an individual contributor. And then ultimately your ability to scale your knowledge set comes down to how well can you manage other people? How well can you influence your management and other key stakeholders in the business? And how well can you drive business with your clients and investors and other stakeholders? Yep. And if you're a really good individual contributor, there's a ceiling on how much you can do in a given day. But if you can all of a sudden find a way to influence employees, investors, and management in your firm to drive business, then that becomes a whole different skill set. And I think that that's probably, in my view, the thing that I've always looked for in terms of the people that make the jump from, individual contributors at an associate and VP level to people that can jump up to like a management, level job as a director, a managing director, portfolio manager, or whatever.
I have nothing else, Carlos. I think what we should wait for is questions, and people can DM us or whatever they like on LinkedIn, and happy to field any questions. And we could do another session in a month or so, answer some of those questions live or something. That being said, if anyone listening to this has any questions, comments, or just wants to reach out and bounce ideas, we're very, very active on social media and LinkedIn, and we're very willing to have conversations with people in private to make sure that people are learning and progressing in their careers. It's something that's really important to both of us, so please feel free to reach out.